Welcome back, everyone. Today, we are tossing a wild, highly volatile microcap stock right into the guru gauntlet. We're going to take legendary financial frameworks from some of the greatest investors of all time and apply them to the absolute chaotic reality of the modern market. Our subject for today, 707 Cayman Holdings, ticker JEM. Let's analyze it purely through these structured, legendary investment lenses.
Okay, let's dive right into our roadmap for this explainer. We're going to start with a quick snapshot of the company, JEM, then view it through the legendary lenses of Warren Buffett, Peter Lynch, and Benjamin Graham. After that, we'll run a discounted cash flow and look at some alternate valuations before wrapping it all up with a final synthesis and verdict.
So, Section 1, our JEM company snapshot, fast fashion meets Web3. 707 Cayman Holdings, or JEM, is a digital native direct-to-consumer fashion brand aiming right at Gen Z and millennials. They do private label apparel, dropping new styles every single week. But guys, when you look at the financials, there is just a massive disconnect. The stock price sits at exactly $3.97, which gives JEM a microscopic market cap of just $7.15 million. Yet they pulled in almost $14 million, $13.74 million to be exact, in revenue over the last 12 months. And here's the real kicker. They have a net cash position of $4.78 million. So the market values the whole shebang at barely over $7 million, but nearly $5 million of that is literally just liquid cash sitting in the bank. It is the absolute messy reality of microcap stocks perfectly encapsulated.
But wait, there is a total plot twist here. Despite being in the incredibly cutthroat fast fashion space, JEM recently signed a memorandum of understanding to pivot into Web3. Yeah. No joke. They're actually exploring building a crypto treasury reserve to hold Bitcoin, Binance Coin, and Ethereum, and they want to operate a GameFi business, basically mashing up video gaming with crypto finance. It's a completely bizarre pivot from trendy denim to hoarding crypto. So keep this incredibly unfocused management strategy in the back of your mind as we bring in our legendary gurus.
Moving on to Section 2, the Warren Buffett lens, moats and management. Let's see if JEM can survive the Oracle of Omaha's pristine, rigorous standards for long-term value. So the crucial point is right here in this checklist. Buffett demands an economic moat, right? Well, JEM is competing against absolute behemoths like Shein and Zara, so there's literally zero moat here. The competition is intense. What about management? We just saw they are totally distracted by a crypto pivot. Earnings? Completely negative. Their return on equity is a staggering negative 133.41%. Now, the only thing JEM actually passes on is debt. They hold a very manageable $511,000 in debt against their $5.29 million total cash. But their owner earnings, which is what Buffett calls free cash flow, sits at a painful negative $1.33 million.
So, what does this all mean for Warren Buffett's intrinsic value target? It's $0. With a negative free cash flow of $1.33 million, absolutely no competitive moat, and a management team pivoting from dresses to crypto, this company fundamentally lacks the consistent earnings power you need for a margin of safety. For Buffett, this is an undeniable hard pass.
All right, Section 3, the Peter Lynch lens, categorizing the play.
You know, Peter Lynch famously said, "You've got to categorize your stocks." And a company that completely fails Buffett's quality test might actually be a perfect fit for one of Lynch's speculative categories. Based on Lynch's framework, JEM isn't a fast grower or a stalwart. It's categorized strictly as an asset play. Why? Because it's trading incredibly close to the actual value of its cash. The balance sheet is stellar. Plus, what Lynch would absolutely love here is the ownership structure. Institutional ownership is almost non-existent at just 1.68%. Which means Wall Street is completely ignoring it. But insider ownership, that's a massive 43.56%. For Lynch, that kind of heavy insider ownership is a huge green light. It signals internal confidence that the underlying assets hold real value.
Under the Lynch lens, this stock has a hard valuation floor based on its net cash per share, which comes out to exactly $2.66. Think about it, if you buy near this price, you're basically getting the entire apparel business and that wild crypto pivot for free. You're strictly paying for the cash sitting in the bank. So for Lynch, this makes JEM a speculative buy or hold, purely as an asset play. That is, of course, assuming you can stomach the ongoing cash burn.
Next up, Section 4, the Benjamin Graham lens, the defensive investor.
Benjamin Graham, the absolute father of value investing and Buffett's mentor, was famously conservative. When we run JEM through his defensive investor checklist, it's pretty brutal. Graham requires a massive margin of safety and huge stability. JEM fails his adequate size test right out of the gate.
At a $7.15 million market cap, it is miles below his $50 million minimum. It also totally fails his earnings stability and dividend record tests, basically because it has neither. Now, it does pass his financial condition test with a really strong current ratio of 2.81, and its price-to-book ratio of 0.80 easily clears his valuation filter. But overall, it is completely failing the defensive checklist.
And this brilliantly illustrates what happens when you try to apply classic value formulas to money-losing microcaps. Graham's famous intrinsic value formula is the square root of 22.5 times earnings per share times book value per share. So if we plug in JEM's actual data, we get 22.5 times a negative $4 EPS times a $4.97 book value.
The result? Well, it's literally not applicable. It completely breaks the formula. You simply cannot calculate the square root of a negative number. Because JEM's earnings are so deeply in the red, Benjamin Graham's model just shatters. He wouldn't touch this stock with a 10-foot pole. Under his strict margin of safety rules, this is a definite massive sell.
Let's move to Section 5, DCF valuation, forcing the turnaround.
Because their current free cash flow is negative $1.33 million, a standard discounted cash flow model just spits out a value of 0. So to actually make the math work, we have to play analyst here and force a hypothetical turnaround scenario. Step 1, we assume management miraculously fixes their operations and hits a 5% free cash flow margin on their current $13.74 million in revenue. That would generate roughly $687,000 in positive free cash flow. Step 2, we project a modest 5% annual growth over our forecast period. Step 3, we discount those cash flows back to today using a 10% weighted average cost of capital. And finally, we apply a 2% perpetual terminal growth rate.
When we map that out on a sensitivity table, and we focus right on the center at our 10% discount rate and 2% terminal growth intersection, the fair value of JEM hovers right around $5.40 per share. But listen to me carefully here. This $5.40 valuation literally only exists if management executes a flawless turnaround to profitability. If they keep burning cash on GameFi and crypto pivots instead of fixing their apparel margins, this DCF model goes straight back to 0.
All right, Section 6. Other valuation models, price to sales and reverse DCF.
Before we bring it all together, let's look at two alternative metrics to round out this financial gauntlet. On one side, we have our net cash value model, which provides a rock-solid floor valuation of $2.66 per share. That's based entirely on the company's liquid assets minus its debt. On the flip side, we have the price-to-sales multiple. JEM is trading at an extremely low 0.52 times sales. To put that into perspective, if JEM can just normalize its operating margins to standard industry levels, a 0.52 multiple implies this company is incredibly undervalued. But again, everything, and I mean everything, hinges on fixing that nasty cash burn.
Finally, Section 7, synthesis and final recommendation.
Let's move to the summary and see how this all builds together. The models are aggressively split, and it's based entirely on how they treat the company's giant cash pile versus its ongoing operational cash burn. At the current price of $3.97, Buffett says sell. The fair value is 0. Graham says sell. The formula is literally broken. But Peter Lynch, he sees an asset play, suggesting a speculative buy near that $2.66 cash level. And our forced turnaround DCF model suggests holding for a potential upside to around $5.40.
The reality of JEM is just a massive financial tug-of-war. The strengths are heavily concentrated on the balance sheet. You've got this huge $5.29 million cash pile, a super low price-to-book ratio of 0.80, and a very high insider ownership of 43%. But the risks? They are severely operational. They are actively burning negative $1.33 million in free cash flow a year, they're facing brutal competition from fast fashion giants, and they've got this highly distracting Web3 and crypto pivot happening at literally the worst possible time. It's almost the textbook definition of a potential value trap.
So what actually triggers a buy for each of our gurus? For the Buffett camp, you sit on your hands and wait until JEM proves it actually has a moat and a consistent positive return on equity. For the Graham camp, you literally have to wait for a positive earnings per share just to calculate a margin of safety. For the Lynch followers, the trigger is straightforward. You buy at or under the $2.66 net cash value. And if you're leaning on that DCF model, you only buy at today's $3.97 price if you're absolutely confident that management can execute a turnaround to a 5% margin.
Which leaves us with one final ultimate question. Does JEM's massive $5.29 million cash pile make it a hidden gem of an asset play, Or is this bizarre Web3 crypto pivot just going to turn this fast fashion retailer into a devastating value trap? That's for you to decide. Thank you so much for joining me to run the gauntlet today, keeping our learning focused and right on the data. I'll see you in the next explainer.